Next, let's look at loans. So at the top here, just try calculating these percents of these numbers. So remember, whenever we calculate a percent of a number, for instance, this one, we would have to change that percent to a decimal. So this would be 0.18, and then we multiply it by the number. So 0.18 times 1,900. And if you put that in your calculator, you should get 342. So I'm just going to fill in the answers for the rest of these. So this one here, you'd have to do 0.5 times 6,000. This one you'd have to do 0.8, and this one you'd have to do 0.09. And here are the answers. So this one would be 768, and this would be 288. So now let's look at different types of loans in this table. So it says one way to borrow money is to get a loan. With most loans, interest is calculated daily and paid monthly. Loans are either secured or unsecured. A secured loan requires collateral. So if we look on the side here, it says collateral is an asset such as car or property that the lender may take if the borrower can't repay the loan. So if you're getting a really big loan of money, the bank wants to ensure that you will pay that money back. So in order to do that, you will have to give a collateral. For instance, if you have a new car, you could say, okay, if I don't pay my loan back, the collateral is that you can take my car. So then if you do that, then the bank will be okay with giving you the loan. So if we look at this chart and the different types of loans, you can see that we have some that are secured and some that aren't secured. So some of them are secured by a collateral, and that depends on what the collateral will be. Some of them are not secured, so you don't even need a collateral of any sort. For the auto loan, there is a collateral, and it's automatically the vehicle that you are loaning. Now, sometimes when you get a loan, it has to be intended for a certain purpose. For instance, a student loan is purely intended for tuition only. An auto loan is intended for a vehicle, and a payday slash fast cash advance is for items needed before payday. However, for these personal loans, there are no restrictions on what you can spend it on. So that could be money for literally anything. And then it just says here when the interest is paid and then the interest rates. Now, of course, it's nice to have a low interest rate, but because of that, there are other consequences. So you'll notice for the two personal loans, this one here has a low interest rate, which is awesome if you don't pay off your loan fast enough. However, you need to have a collateral for it. But for the personal loan above it, it says it is unsecured, so you don't need a collateral. However, the interest rate is high, so if you don't pay it off fast enough, you are going to owe a lot of money on it. So let's look at this example with Doug. It says Doug wants a secured loan to start his own painting business. Doug will use his car as collateral. The bank will loan Doug 75% of his car's equity. Doug's car is worth $45,000, but he owes $15,000 on it. How much will the bank lend Doug? So first we need to figure out what the equity is in Doug's car. So how much money would he be able to get from the car if he were to sell it right now? But he still owes $15,000 on it. So the car is worth $45,000, but Doug owes $15,000 on it. So we're going to have to subtract that from the $45,000. So really the equity of the car, if they were to sell it right now, would just be $30,000. That's how much they'd be able to get if they were to sell his car. Now it says that the bank will loan Doug 75% of his car's equity. So we need to find 75% of this $30,000. So what we're going to do there is we're going to change this percent to a decimal. So that would be 0.75, and we're going to times it by $30,000. And if you plug that into your calculator, you should get $22,500. So therefore, the bank will lend Doug $22,500. In the next example, it says Brittany is borrowing $3,200 for 6 months. She has good credit. What type of loan should she get? And justify your answer. So there's a lot of different answers you can give for this one, but I'm going to write down mine and then I will explain it. So Brittany is borrowing that $3,200 for 6 months, and 6 months is a long time to borrow money. That could be potentially a lot of interest. So Brittany is probably going to look for a loan that has a low interest rate. So if we're looking at these ones here, the ones with a low interest rate are this one, this one, this one, and this one. Now, she's not going to get an RRSP. That's used for retirement, so that's out of the question. She's not using this loan for a car, so this one's out of the question. And it doesn't say if she's using it for tuition or not, so I'm going to assume she is not using it for tuition. So because of all of this, I would say that this personal collateral loan, or it would have to be secured, would be the best option for her. So that's what I wrote. I wrote a secured personal loan because it would cost the least interest. And we want a low amount of interest because she might not pay this balance for months. The interest would be high if she didn't pay it for months. And interest on payday loans are very high, as well as an unsecured loan that would have a higher interest rate. So if we compare some of the other loans, the payday loan has a high interest as well as a unsecured personal loan. So because of this, I think a secured personal loan would be the best because it would have the least amount of interest. However, if you gave a different answer there, but you justified it in a different way that made sense, then that would be okay too. Now let's look at example 2. It says Brenda is lending Fatuma $600 to buy a sewing machine to start a small business. Brenda charges simple interest at 2% a year. At the end of 1 year, Fatuma will repay Brenda. How much will Fatuma owe? So remember, we have our simple interest formula. I is equal to PRT. So that's the principal amount, the rate as a decimal, and the time in years. So let's just multiply all those numbers. So the principal we have is $600. The rate, she said, is 2%, so we're going to write 0.02. That's a decimal. And then it would be 1 year, because it says at the end of 1 year. And if we multiply all those numbers together, you should get $12. So therefore, we're going to do 600 plus the $12, so the total amount is $612. So Fatuma will owe $612 after 1 year. Finally, Nicholas is paying his $18,900 student loan. His interest rate is 3.2% per year. It is compounded daily, so we know this is a compound interest question, and payable monthly. In his first payment, Nicholas will pay the interest owing. He will also pay an extra $300 of the principal. How much is Nicholas's first payment? So this is a lot to unpack in a question. Remember, Nicholas is going to pay in his first payment the interest as well as an extra $300. So we need to figure out what his interest is going to be for the first payment. So what interest does Nicholas owe? So remember, this is a compound interest question, so we have to use this formula here. So the principal amount we have is $18,900. Then our rate is 0.032 or 3.2%. And then they actually filled in the rest of these blanks for us. It says it's compounded daily, which is why it has 365 written down there. And since it's payable monthly, they used 30 because I guess there's 30 days in whatever month that Nicholas is in right now. If you use 31 there, that would be okay as well, because it would be, since it's compounded daily, it would be compounded 30 times in that 1 month. Therefore, let's calculate all this in our calculator. If you do that, you will get $18,949.77. So now we need to calculate the interest from that because this here is the amount after the interest is added onto it. So we're going to take that amount, $18,949.77, and we are going to subtract the initial or the principal amount, $18,900. So in total, you should get $49.77 for the interest. So that's the interest that Nicholas is going to pay, but we also have to add on that $300 to it because he said he would pay $300 as well. So here I'll just highlight those two things. So then the payment's going to be $49.77 plus $300. And that would equal $349.77. So Nicholas's first payment will be $349.77.